All right, guys, so welcome back. And now it's time to get into some specific examples of how the wheel strategy can work. And I'm going to start off real simple Apple. First thing we're going to do here is find a strike that we are interested in selling. Okay, you'll see we have the nearest strike, which is just 6 days out to expiration. And I'm going to go ahead and get all the strikes pulled up here just so you can see all the different levels that you can choose from. That's a weekly option for you. So what you could do is sell like a cash secured put on a weekly basis. If you're betting that Apple is not going to move down to, let's say, the 145 level in this next week, then you could sell a cash secured put at that level. 142, you're going to get less premium for that, obviously. But if we go back here, you can see the specific premiums associated with each option level. So let's say, the first thing we're going to do is sell a weekly option at 142. A cash secured put. So we're going to go ahead and hit the bid on this. It's last traded at 71 cents. We own, let's say, 100 shares of Apple. Go down to make sure you adjust the quantity here of 1. And then we're going to go ahead and look over this. We're going to get 71 cents in premium. We're going to do a limit order because limit orders are best for options. You can still do market orders. It's not really going to matter that much when you're looking at small quantities. But if you're doing large quantities of options contracts, I would definitely recommend doing a limit order. It's best practice to do limit orders with options when you're, because the spreads can be pretty wide. And so you don't want to get filled at a bad price, right? So I always try to do limit orders. But, so essentially, if we were to do this, you'd receive $71 less commissions. And you'll see that your max loss here, your max profit, as usual, right? Your max loss is going to be basically less the premium, and then the capital you're committing, which would be $14,200. You're receiving $71, and so that's the first step, right? We're going to say we go ahead and sell this to open, and then we can look at Apple, right? When you go to, let's say it does finish down at, let's say we have a big sell-off this week and the stock finishes at 140. Well, then the next step, right? Step number 2 is we're going to go ahead and come back and we're going to sell a covered call because now we're long the stock because that option finished in the money. So it's auto exercised and now we're long that stock. So we're going to sell a covered call for the next weekly strike. Just pretend this is September 30th, right? So September 23rd, but if you go to the next level is September 30th. So we're going to do another weekly option here. And we're going to go ahead and sell at, let's say we think it's going to go back up to, 150, right? Now, these options premiums will definitely adjust, right? If the stock went down to 142, you're not actually going to receive $455 for this, right? If you're betting it's going to go back to 150. But nonetheless, it gives you an idea of how this can be implemented. Now, let's say Apple rallies back, right? The option's in the money. So we lose our shares. Well, now we can repeat the process again, go back to selling cash secured puts. And a lot of people do this on a weekly basis. They just keep on rotating and rotating. You can also do this on a monthly basis if you want to get more initial premium. Just remember that when it comes to time value or theta decay, right, it's going to be highest on those weekly options because there's such little time for the stock to make a move. And so that is going to benefit you as the option seller. So selling weekly options has the most potential for theta or time decay versus like a monthly or, one that's more than a month out, just something to keep in mind. But that's essentially the wheel strategy for you. It's very, very simple, as we were discussing, but that's a specific example. Now, if we take a look at, once again, a stock like Palantir, stock that's more volatile, has a higher beta. We're going to get into that in another lesson, as I mentioned, but you can see here that we can do the same thing, right? We have the weeklies, we have the monthlies, we have the bi-weekly options. You can do it every 2 weeks or whatever strategy you want to go for. But let's say, Palantir has earnings coming up, just as an example. They don't actually, I don't think, have earnings coming up this quickly. But we'll just assume that, they're coming out with earnings like this week. And so we're expecting Palantir to make a big move. Now, we're going to sell this cash secured put here. And we're going to say that we don't think, Palantir is going to go below $7 per share. Because, look, the low is $6.44. So let's, sell a $7 put here. And we'll get 11 cents in premium. Now, for this, we'll say we have 10 contracts because the stock is so cheap. So we're putting up, $7,000. And we're going to say the stock's not going below $7. So we'll sell that cash secured put. And then we'll receive $110 for doing so. And our total capital commitment on this one is $6,890. Or I'm sorry, it's $7,000. The max loss is $6,890. Now let's say that Palantir comes out with earnings and they are worse than expected, right? Let's just say that the stock tanks down to $5 per share. So now we had to buy the stock at $7 per share, but we can always turn around and sell a covered call at $7 once again. So keeping that in mind, you look at that and you just have to make the best possible decision in terms of the risk reward you're looking for. So a stock like, I'll give you an example of a low volatility stock. This one is going to be very volatile, so it's not for everybody. But we can take a look at a stock like Procter & Gamble. Okay, I mentioned that in the last video. Procter & Gamble is going to be a lot more stable. As you can see, there's obviously going to be volatility in terms of any stock. But if you look at the highs and the lows for this, right? All the way back in January, it hit a high of 165. Okay, it's now trading at 138. But look at the low here, 129, right? Versus a stock like Palantir, which hit a high of $30 per share. Now, it hit a low of 6. So, ask yourself, how much volatility can you handle? What are you looking for? You can take a look at a stock like Verizon. Verizon has a high of 55 and a low of 41. Now, lately the stock market's been very volatile. And so the best time to do the wheel strategy is when you have a range-bound stock like Verizon for several months. If you're looking at a range-bound stock that is not expected in the near term or maybe over the next month or two to make a big move, right? You can sell a cash secured put and then buy a covered call. And that's the best way to do it. I mean, when a stock is making big downward moves, that's when the wheel strategy gets tricky. Okay, that's you can still make money doing it, but just keep in mind the risk you're taking with the volatility. And that's also why it's never a good idea to just take all your money and put it into one stock doing the wheel strategy. Diversifying, right? 5 or 10 stocks that you can do this against would be much better than just doing it against one stock and hoping that this stock works out for you, because obviously diversification will be important in this strategy, especially if you're trying to potentially, make a living off this. If you're retired, that's when it becomes especially important to diversify. But it ultimately comes down to risk tolerance and what you're looking for. But nonetheless, I mean, we can see that Verizon has made a pretty good downward move here. But look at something here, though. I do want you to notice. Look at the dividend, okay? So you'll see that Verizon had a dividend of $1.55. They paid out, let's see, those were earnings, I'm sorry. So the dividend is 64 cents. Yeah, so the dividend right there is 64. You'll see that right there. Every quarter they're paying 64 cents. And so you'll see here the payable date and everything, 7/7/2022. Now the X day is going to be before that dividend is actually paid. Okay, so when you're doing the wheel strategy, that's just something to consider, because if you can sell a covered call with a strike that is out of the money, let's say, and even if it goes in the money before expiration, sometimes you will have people exercise those options early, and it's based upon a random exercise, and you never know when it can happen. But a lot of times you're going to be able to hold your shares until expiration, and even if that stock is in the money, right, or if that option's in the money, so you can potentially collect that dividend if you're selling past the X day, because remember, with the X day, you want to own the stock a day before the X day. So as long as you have those shares in your possession, in your account, one day before the X day, and then you're able to hold on to your shares until the X day, right? You can sell your shares on the X day and still receive that dividend. Well, then you can look at strike dates or expiration dates that would have the potential for you to be able to hold on to your shares and also receive that dividend as well when you're doing this strategy. Okay, now I did say we're going to go on over to TD Ameritrade, and I'm just going to show you how to do it on like a classic website, because it's something else to consider, right? I've been showing you Thinkorswim, but what if you want something easier to kind of play around with? So I'm going to go ahead and log into my account, and give me one moment here. Hopefully it doesn't ask for a text message or anything, because I don't have my phone on me right now. Okay, there we are. And don't mind my portfolio, the history right now. That's another story. But nonetheless, this is my high-risk portfolio, by the way. This is not for options. This is my penny stock portfolio, so keep that in mind. Nonetheless, that's a different story altogether. Okay, let's take a look at Palantir once again, just as an example. Let's go ahead and sell to open this, Palantir Technologies, as you'll see, PLTR. Let's go ahead and we're going to sell to open the 30th. No, let's go for the 23rd. We're going to do that weekly option. We're going to sell a put, and we're going to go ahead and get long at, let's say, $7, because we don't think it's going lower than $7. And so, as you'll see here, 5 cents. Now, I think it might be showing up differently, actually, on the Thinkorswim. And that's something I'm going to have to look into in terms of why the options premiums are showing up differently, but I could have swore it was showing up, like you'll see here, $7 September. Oh, that's the 30th of September. That's why. Because I thought I was looking at the 23rd. So I think it is going to be the same then. If you're looking at, yeah, so it's the same. So it's correct. I was wrong about that. So looking at this, though, you'll see the September 23rd expiration, $7 put, right? And we're looking at this right here. That's how much you're going to get. So you take 5 cents, the bid price, times 100, and you get $5 basically for each options contract. So not much. But since Palantir is so cheap, right? If you sold 10 contracts, well, how much capital you're committing? 7,000, and you receive $50. Okay, maybe not a huge amount, but it can be used for passive income. You're putting up $7 and you're putting up $7,000, and you're betting that Palantir is not going to drop below 7 within the next week. And if it does, hey, you get long Palantir at $7. The stock is down a lot. Ask yourself, with each of these trades, are you comfortable getting long the stock if it goes below the strike price? That's so important, right? Because you're going to be long in that stock, and then you're going to have to ask yourself, where do I go from here? What if the stock keeps going down? Just something to consider. Now, let's say the stock does finish below $7, then you can turn around and you just sell a covered call. So instead of put, you'll just switch it to call right here. And each broker will be a little bit different. This is on the TD Ameritrade website. I think they make it pretty easy, actually, to trade these options and everything. I mean, when you're looking at, let's do the $7 call, or we'll even say, since it's trading at $7, we're going to sell a $9 call. Okay, we'll just say that as an example. But the concept is the same, right? Let's say Palantir is at $5, and then you had to get long at $7. But for the sake of this example, to give you kind of an idea of what kind of premium you could expect if Palantir were to make a move like that, you'll see that the 1 week out to expiration, not going to be much, right? 2 cents, because Palantir is not expected to make a big move to the upside. So those options premiums are going to be less. Okay, so based upon the options premiums, people are actually expecting, a move. And really it comes down to how much is out of the money, right? So, I mean, you have 2 cents for it to make a move up to $9. That's how much premium you're getting on the option versus $7 strike, right? That's only 78 cents out of the money. So you're getting a little bit more. You're getting 5 cents or $5 per options contract. If we go to the $10 strike, we can see like how much you would get for that. For the call options here, you're only getting 1 cent, okay? Because for Palantir to make a move to $10 by the end of this week, not going to happen, right? So it's Saturday, right? So we have, 5 days for this stock to make a move above $10. Most likely not going to happen. So if it does happen, hey, anything's possible, right? They could come out with amazing news and the stock goes to $12 or $15 and, or something crazy in a day. But is that likely to happen? No. And so that's always going to be factored into the options premiums that you receive. And so when we're looking at this, I mean, just keep that in mind, right? Because the likelihood of this moving all the way down, if we look at the $6 put strike, for example, you'll see the same exact thing. The likelihood of Palantir moving down to $6 per share within, a week is highly unlikely. So I'll give you an example, though. I mean, if you're looking at, let's say you had $500,000, okay, in cash. And obviously, it'd be, kind of risky to put $500,000 all on the line here within a single trade. But nonetheless, I mean, just as an example, and I have a spreadsheet actually with a $2 million portfolio that I've been doing it against one single stock. And I'll show you guys that here in the next video, okay? I think I mentioned that I would do it in the actual wheel strategy video, but I'm going to make a separate video where I actually show you my spreadsheet that I have and kind of go over the numbers and, what that's done and whatnot. So essentially, though, I mean, look at this, right? You had $500,000, and let's say you were looking to sell the $6 put strike. Okay, so with $500, the likelihood of this happening Highly unlikely, but let's just say it does in the next week. So you have the ability to buy 83,000 shares. Now you divide that by 100 because each options contract is worth 100 shares, and that allows you to sell 833 contracts for a $500,000 capital commitment. So in this case, you got $833 that you just made, and like I said, the likelihood of this moving to $6 per share in the next week is not likely, although it can happen. And so that's really what it comes down to. Like, you're still getting $833 from this, just for taking the risk that it moves down below 6. Okay. Same thing if you were already long the stock and you're betting that the stock is going to go back to $10. All right. So in this case, we'll assume that it did go below 6, but we're going to switch this to call, and you'll see you're still only getting one contract there, right? Or 1 cent per contract. But I mean, if you're willing to take a little bit more risk, that your shares will get called away, let's say at $9, there's 2 cents. At $8 or $8.50, right? 5 cents. So now we're really talking, right? If Palantir moves up 80 cents, which definitely could happen, you're going to get $4,165 in a week just for taking the bet that your $500,000 position will not go above that strike price. And once again, this is extremely hypothetical, so it's obviously going to vary a lot in the real world. But you can see that's a little bit, almost 1% of the trade value there. And so that's what's so powerful about this strategy, because when you're looking at how to not only generate passive income for your portfolio, but also like how to increase the rate of return against your portfolio by selling covered calls, by selling puts, whether you're doing the wheel strategy or whether you're doing this just to make additional income against, let's say, blue chip dividend stocks. This can be a very, very powerful strategy. And my favorite way to do it, honestly, would probably be, against blue chip dividend stocks. If you already own a lot of dividend stocks in your portfolio, simply selling covered calls against them is probably going to be my favorite way of doing things. But the wheel strategy, very powerful as well. So, ultimately it comes down to what you're looking to accomplish. What's your risk tolerance? And I mean, what are you trying to do for your portfolio? So that's what it ultimately comes down to. But when it comes to this strategy, guys, it can be very, very powerful. So just keep that in mind. And, with that being said, I will see you guys in the next video. And until next time, the next video will go over the actual spreadsheet, and I'll show you guys how this can, work in real life. I've actually been keeping a trade journal, and I'll show you guys how this works and everything in that next video. So I'll see you guys in the next one, and we'll talk soon.